Hi, Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG Weekly Recap. So October historically is one of those months where you see, high turbulence in both stocks and bonds, and this October is no different. And so this past week, one of the big market movers is the growing cases, the growing COVID cases within Europe, and now they have to make some pretty tough decisions as to how to address that. On top of that, there's this lack of political will to add more stimulus at this time. So we're watching yields in Germany become even, or around the European Union, come down even further. And in Germany, their biggest market, their 10-year Bund, which compares to our 10-year note, yielded minus 65 basis points in the middle of the week. It has improved a little bit, closer to 60 as of this video, but that puts downward pressure on our yield. So what we watched this weekend was this ultra safe haven trade into the treasury market. Treasury yields have been all over the place. We were as high as 79 on Monday. Here we are on a Friday at 74, but we dipped down to 69 on Thursday in response to this COVID news. So we've already been in a big range this week, but mortgage bonds have not been participating in that rally. I think one of the big things to be sharing with clients and partners is that when we see an ultra safe haven trade like we did this week, that's going into the US dollar, that's going into treasuries, not in mortgage-backed securities. And frankly, since September 1st, prices have been really kind of moving lower. And you could see here the chart, we've broken below support. This support at 104.59, we broke earlier this week. And here we are on a Friday, not getting above it, at least not for now. We'll see what happens, but it doesn't look like it's going to do that. So there's this weight that's on the mortgage-backed security market. And so this ultra safe haven trade doesn't translate to better rate sheets. Now, looking ahead, there's a couple of big things. Obviously, the biggest story is the stimulus. It's on, it's off. What's going to happen? With only a few weeks to go to the election, maybe something smaller comes in, probably not. But what is for sure going to happen, we are going to get a stimulus package post-election, depending on who's the president. One's going to be big, the other is going to be even bigger. And with it, again, at the expense of reminding us every weekend, stimulus package brings three things that bonds don't like. Number one, it adds more supply. Now, next week is a boatload of supply coming to the market. We're going to have so much. It's going to be another $2 trillion package, likely. That's even more supply for as far as the eye can see. So the supply is one problem. Number two, the inflationary aspects. We're already starting to see a bunch of inflation. We're seeing it in lumber. We're seeing it in the cost of a home. We're seeing it in the auto sector. And so there's a bunch of inflation out there. And I think that's why yields have elevated. So that's the second thing it does. And then the third thing, obviously, is an aid to the economy. Now, I looked at this morning's retail sales number. That was a phenomenal number. And when you couple that with the savings rate, ultra high savings rate, and we've taken 1 million people off of unemployment each of the last 2 weeks. That points to what should be an incredible holiday shopping season. I think all this bodes well for stocks and maybe not so well for bonds. We'll see what happens as we move into the fall. But for right now, rates are incredible. The Fed is buying and supporting the interest rate market, and we have this relative underperformance around the globe that should keep a lid on how high our rates can go. Hope this finds you well. Have yourself a great weekend. We'll be back at it soon. Bye for now.